Imagine this. It's nearly Christmas, 1857. Holidays approaching. But for Ulysses S. Grant, future president, then just a struggling farmer near St. Louis, things are bad.
Really bad.
Yeah, so bad that 2 days before Christmas, he actually walks into a pawn shop
Oh, wow.
and pawns his own gold watch and chain. Just tells the broker, sell it if you need to, just to get cash. That personal struggle, it happened right in the middle of this huge economic collapse, the Panic of 1857.
And what's just staggering is the speed, right? How fast it all went down.
Exactly. 1 minute, the economy is just roaring. Railroads are booming everywhere. Land speculation is completely off the charts. Money seems easy.
Like a party that everyone thinks will never end.
Right. And then, boom. Weeks later, it feels like the whole system just implodes. Banks failing left and right. Markets crashing. Businesses just vanishing overnight. It was like a whirlwind.
That contrast is powerful, isn't it? Grant's watch, reflecting this massive nationwide crisis.
And that's what we're digging into today. This whole deep dive is about getting under the hood of the U.S. Panic of 1857. We've got, a pile of sources here, academic papers, historical accounts.
Trying to piece together a really complex puzzle.
Yeah, our mission is to go beyond just, the headlines. We want to trace the surprising connections. Things like a major Supreme Court decision, this absolutely wild railroad investment bubble, speculation gone mallet, bank failures everywhere.
And how all that connects to the growing tensions between North and South, the stuff that would eventually lead to the Civil War.
We want to connect those dots for you. See how something like a court ruling about slavery or even a ship full of gold sinking could interact with these deeper economic weaknesses.
And create a crisis that didn't just ruin fortunes, but actually helped set the stage for the war itself. It's fascinating and, frankly, pretty scary stuff.
Okay, let's get into it. To really feel the bust, you first need to appreciate the boom. The years leading up to 57 were just incredible growth, almost frantic.
Absolutely. The sources call it the Industrial Revolution, really kicking into high gear in the U.S. It wasn't just slow growth. Things felt like they were fundamentally changing, and fast.
Like what, specifically?
Well, for one, a huge number of new banks were popping up all over. And you have to remember, the banking system then was very different. Decentralized, lots of state banks issuing their own paper money.
So more banks meant way more banknotes flooding the system.
Exactly. Which fueled activity, but also added, layers of risk and complexity. It wasn't all backed by gold or silver.
And the railroads. You mentioned railroads were central.
Oh, man. The railroads were the story of the 1850s. It was like the dot-com boom, maybe, or crypto now, in terms of the public excitement and investment mania.
How big are we talking?
The actual miles of track laid down and the money invested, it tripled just between 1850 and 1857. Tripled.
Wow.
And it wasn't just about moving goods and people faster, though that was revolutionary. It was a massive industrial engine itself, demanding iron, coal, timber, labor, and investors. They were absolutely obsessed.
Right. And alongside that, the North was industrializing fast, too.
Yeah, rapid expansion in manufacturing. You had textile mills in New England, foundries making iron, factories producing all sorts of goods, growing fast, hiring lots of people.
And the South?
Continued strong growth in cotton production, which was, of course, completely tied to the expansion of slavery. That was seen as the bedrock of their economy.
Plus, the California gold rush effect was still ongoing, wasn't it?
Still pumping actual gold, real specie, into the economy. So you put all that together, new banks, railroads transforming everything, industry booming, cotton strong, gold flowing in. It felt like limitless opportunity, like everyone was getting rich, or could.
And that feeling, that optimism, it fueled this massive wave of speculation, right? Especially in land.
Huge speculation. People weren't just buying land to farm or build on, they were flipping it. Western land speculation was insane. We're talking property in new Western cities, maybe places like Chicago or even smaller towns further out.
Changing hands how often?
Sources say sometimes 10, 11, even 12 times in just 2 months.
12 times in 60 days. That's not investment. That's just pure gambling on price increases.
Purely. It was all about catching the rising tide, selling to the next person for more. Look at Omaha property values jumped from maybe $500 to $5,000 in just 1 year, spring 56 to spring 57.
A 900% increase. That's bubble territory.
Absolutely. And there was this almost religious belief, especially out west, that, quote, everybody in the West had a share of God's earth, quietly increasing at a rate of perhaps 100 or at least 20% per annum, it was hoped.
It was hoped. That little phrase says everything, doesn't it? A little bit of doubt creeping in.
It really does. And railroads were right there, smack dab in the center of this investment fever. Railroad stocks, railroad bonds, they were the hot new thing, the future.
And not just Americans buying in.
No, huge amounts of foreign capital poured in. British, Scottish, French investors, hundreds of millions sunk into U.S. railroads. They saw America, especially its expansion, as this huge growth opportunity.
Okay, so the boom looks amazing on the surface.
Yeah.
But you mentioned fragility. Where were the cracks?
Well, despite all the money pouring in, especially into railroads, the investments weren't always, let's say, based on solid ground or even understandable ground.
What do you mean, like bad business plans?
Worse than that, often. The level of transparency was just non-existent by today's standards. Forget about GAAP. Generally accepted accounting principles, they were completely unheard of.
So companies didn't have to report their finances.
Very few did in any meaningful way. Income, expenses, where the capital raise was actually going, often a complete mystery. Think about this. The New York Stock Exchange itself didn't require companies to give shareholders an annual financial report until 1869.
1869. So during this whole 1850s boom, investors were basically flying blind, putting money into black boxes.
Actually, yes. There's a quote from a business treatise back then that's just brutal. It says basically that companies showed no regard for the truth in stating where their capital came from, and shareholders were often as uninformed after reading a published financial statement as if none had been rendered.
Wow. So even the reports they did get were useless or misleading.
Often, yeah. It suggests a systemic lack of reliable information.
That's unbelievable. How could anyone make a sensible investment? You're just throwing money based on, what, hype?
Hype, rumors, the general euphoria of the boom, the promise of future growth, connections, but not hard data. And adding to the risk, management wasn't always, shall we say, competent or even honest.
Scandals.
There were definitely warning signs, major fraud cases, like Robert Schuyler with the New York and New Haven Railroad in '54, allegations of bribery involving land grants for railroads like the La Crosse and Milwaukee out west. For investors, especially those buying into these newer Western lines, they often had zero clue if their money was building track, lining pockets, or funding some speculative side project.
Okay, so you've got sky-high expectations, this belief that values will rise forever, combined with almost zero reliable information, very little oversight, maybe even corruption.
Exactly. That creates these huge structural weaknesses, massive holes in the whole system connecting banks, markets, railroads, government. It's like a web built with rotten threads, just waiting for a shock.
A system ripe for collapse.
Precisely. Just waiting for a trigger.
And it's crucial to remember, this wasn't one single unified U.S. economy back then, right? The North and South were very different.
Hugely different. Their economic engines, their structures, their vulnerabilities were distinct. And this played a massive role in how the panic hit and why it pushed the country closer to war.
How so? What was the core difference the sources highlight?
Okay, think about the Northeast, the Midwest being settled. The ideal there often was the small farmer, the yeoman, their main asset, land. Which is immobile, right? You can't move a farm.
Right. Fixed assets.
And labor was relatively scarce compared to the South. So northern investment tended to focus on improving that fixed land and the community around it. Clearing it, building barns, schools, towns, roads, canals, local railroads, things that increased the land's value and benefited the whole settled area. Even if someone moved west, their past investments stayed put, enhancing those immobile assets.
And this influenced railroad building, too.
Definitely. Northern railroads got big federal land grants, like the huge one for the Illinois Central in 1850. That spurred development all along its route. So by 1860, the North had way more railroad lines than the South.
Okay, so the South, what was their economic foundation?
Very different. A huge chunk of Southern wealth wasn't in immobile land, but in mobile assets enslaved people. Land mattered, obviously, but having wealth that could literally walk away or be moved created a different investment outlook.
How did that play out?
Well, labor, due to slavery, was seen as a relatively abundant. Agriculture, especially cotton or tobacco, often used shifting cultivation. Farmland intensively till it's worn out, then move on, clear new land. Less incentive for permanent intensive improvements on any single plot. Sources say Southerners cultivated maybe 1/3 of the land they owned, while Northerners improved over half.
So let's focus on developing fixed infrastructure and improving specific plots of land.
Generally, yes. And this difference, wealth in mobile versus immobile assets, helps explain why the South got fewer federal land grants for railroads. By 61, the states that would form the Confederacy had only about a third of the rail lines and a fifth of the railroad workers compared to the North. Different priorities, different economic logic.
And we can't isolate the U.S. economy here. Europe was involved, right?
Yeah.
Especially with those railroad investments.
Deeply involved. European money was crucial fuel for America's growth, especially infrastructure.
But that wasn't guaranteed to last forever.
No. Right before the panic hit the U.S., Europe had its own financial pressures. The Crimean War, fought from 53 to 56, was expensive for Britain and France. Plus, they were funding costly colonial projects elsewhere.
So money was getting tight over there.
Exactly. European banks and investors needed capital closer to home, so they started selling off some foreign assets, including those popular American railroad securities.
So selling pressure started before the U.S. panic really kicked off.
Yes. The value of those U.S. securities was already starting to decline because of this European selling. It added another layer of stress to the system here: internal speculation, lack of transparency, regional differences, and now foreign capital pulling back. The foundations were definitely shaking.
And then right into this already shaky situation comes a massive political earthquake with huge economic ripples, especially for the West. The Dred Scott decision.
A landmark Supreme Court ruling, March 6, 1857, deeply controversial, profoundly tragic. Dred Scott, an enslaved man, sued for freedom based on living in free territories. The court said no.
And crucially, ruled that black people couldn't be citizens and had no rights in federal court. But it went even further, didn't it? On slavery in the territories.
It did. It declared the Missouri Compromise unconstitutional, essentially saying Congress couldn't ban slavery in the Western territories. This legally validated slave property everywhere federally and seemed to throw open the West to slavery.
Now, here's the really fascinating link our sources make. This legal ruling, ostensibly about slavery and citizenship, had a direct, almost immediate negative economic impact.
How?
The argument is it directly undercut the value of Western land.
Wait, allowing slavery decreased land value? That seems counterintuitive.
It ties back to that North-South economic difference. Northerners, especially free soilers, who wanted the West free of slavery for various reasons, principle, racism, economics, they feared slavery's expansion would change the whole development model out West.
How so? They expected slaveholders would move in with enslaved labor. Not necessarily huge numbers everywhere, but the economic model would shift. Remember the Northern model. Invest heavily in improving immobile land clearing, building, creating infrastructure that raises everyone's land value.
Right.
The fear was, if slavery came in, investment would split. Some capital would go into land, but a lot would go into buying and managing mobile slave property, like in the South. This, they believed, would lead to less intensive land development, slower community building, and ultimately lower appreciation of land values compared to a free soil model.
Okay. So Northerners looked at the Southern system, saw less focus on intensive land improvement, and thought, if that model comes west, my land investment won't pay off as much. Settlement will slow down.
Exactly. That fear, that uncertainty about the future economic character of the West created by Dred Scott caused a real measurable stall in westward migration by Northerners. The very people expected to buy and develop that land hesitated.
Fewer buyers, less demand for land, fewer people moving, less business for the railroads.
Bingo. Which led directly to a drop in Western land prices the asset speculators had bet the farm on. And it hammered the value of Western railroad investments. Those railroads were built entirely on the promise of future settlement and traffic. Slow that down, and their whole model crumbles.
That's an incredible connection. A Supreme Court case triggering a real estate downturn and hitting infrastructure stocks. It wasn't just politics, it was immediate economics.
And the sources point to data backing this up. Statistical analysis of railroad stock prices shows a significant negative impact specifically on Western railroad stocks after Dred Scott, but before the big bank failures later that summer.
So the West was already hurting financially because of Dred Scott before the nationwide panic even began.
It seems so. It created this regional vulnerability, pricked that specific speculative balloon out west, setting the stage for wider contagion.
Okay, so Dred Scott destabilizes the West, but that didn't cause the entire system to crash immediately? What were the final triggers?
Right. The system was fragile, stressed, especially out west, but the full-blown panic needed specific sparks. And the sources suggest the asymmetric information model fits 1857 well.
Asymmetric information, meaning People didn't know who was sound and who wasn't.
Exactly. When some big bad news hits, like a major company failing, investors panic because they lack perfect information. They don't know which other banks or firms might also be weak or exposed. So the rational thing maybe is to pull your money out from everyone just in case.
Like yelling fire in a crowded theater, but you don't know where the fire is, so everyone just runs for the exit.
A good analogy. The lack of clarity turns localized bad news into a systemic crisis of confidence. And this model suggests panics can brutally separate the wheat from the chaff, expose the weak firms that were hidden during the boom. Warren Buffett's line, right? You only find out who is swimming naked when the tide goes out.
The tide definitely went out in 1857. So what was the bad news that triggered this run for the exits?
The first big domino fell on August 24th, 1857. The New York branch of the Ohio Life Insurance and Trust Company suddenly stopped making payments.
Ohio Life. Was that a big deal?
Huge. It was one of the largest, most respected financial firms in the country, connected everywhere, held deposits from many other banks. Its failure was a massive shock.
Why did it fail? Bad investments.
Embezzlement. Turns out the cashier had been systematically looting the place. Now, the direct financial contagion was initially limited. The banks Ohio Life owed money to were actually reimbursed relatively quickly. But the psychological impact was devastating.
If Ohio Life could collapse from hidden rot, who else could?
Precisely. Who could you trust? What other skeletons were in the closets of these booming businesses? Confidence just shattered.
And then another blow came just weeks later. Something about gold.
Yes, adding fuel to the fire and hitting actual liquidity, the availability of hard cash. In September 1857, the SS Central America sank in a hurricane.
The ship of gold, right, carrying California gold east.
That's the one. Carrying over $2 million in gold dust, ingots headed for New York banks. A massive sum back then. Its loss was a direct hit to the specie reserves banks desperately needed to back their banknotes and calm depositors.
Okay, so you've got the background weaknesses, speculation, opacity, Europe pulling back, Dred Scott hitting the West. Then Ohio Life destroys trust, and the Central America sinking removes vital hard cash.
Those were the sparks. In that environment of asymmetric information and underlying fragility, they ignited the full panic. The dry tinder caught fire.
And once it started, it spread fast.
Like wildfire. And the telegraph played a role here, ironically. News of failure spread in hours, not days, amplifying the fear and the speed of reaction across the country.
Creating that chain reaction.
Absolutely. Ohio Life breaks trust. Banks panic, start calling in loans to build reserves.
Which squeezes businesses and individuals.
Right. And depositors, seeing this, fearing their bank is next, rush to withdraw their savings in gold or silver coin, the classic bank run. Lines form outside banks.
Driving asset prices down further.
Plummeting. Land values collapse. Railroad stocks crash across the board now, not just the West.
And the banks themselves start to buckle.
They do. Drained of specie. Facing relentless runs, banks began to suspend specie payments, basically refusing to redeem their banknotes for gold or silver, a drastic step.
Where did the suspension start?
Major cities like Philadelphia, Baltimore, Washington suspended on October 13th. The very next day, October 14th, the New York City banks, the financial heart, suspended too. Access to hard money just froze.
Why suspend? Just because they ran out of gold?
Partly that, but also structural issues. Usury laws limited how high banks could raise interest rates to attract funds during a crisis. Normally, you'd hike rates sky high to pull in cash. They couldn't do that effectively. And yes, the sheer force of the runs, suspension was seen as a desperate defense, stop the bleeding, protect some assets, even if it paralyzed commerce.
But stopping payments didn't end the pain, did it?
No, it shifted it and caused a wave of business failures. Bankruptcies exploded. Companies couldn't get credit, couldn't make payments. Big names went down. Jacob Little, the famous speculator, failed, maybe not a surprise, but respected firms too, like the brokerage E.W. Clark, Dodge & Company, failed even before the suspensions. Then Corning & Company, a major securities firm, failed, owing millions to the banks, adding huge pressure right before they suspended.
And the human cost? Jobs.
Devastating. Unemployment soared, especially in cities. Real hardship. There were protests, riots, even like a big violent one by unemployed workers in Tompkins Square, New York City that November. Savings gone or inaccessible, jobs vanished. A disaster for ordinary people.
What about the government? Did the Treasury step in to help the banks lend them money?
You'd think so, but no. The system then, the independent treasury, was designed to keep government funds separate from private banks to protect taxpayer money after earlier panics.
So it couldn't act like a modern central bank injecting liquidity.
Exactly the opposite. It acted almost counterproductively. During the panic, the Treasury sometimes withdrew government funds from commercial banks. Tightening credit further, it even sold bonds, pulling more cash out of the market. The system designed for safety actually made the liquidity crisis worse for the banking system.
Wow, so a perfect storm. Weakness, triggers, fast contagion, and a government structure that couldn't help and maybe even hurt.
That captures the rapid spiral from boom to bust pretty well.
But what's really striking, and you mentioned this earlier, is that the lasting impact wasn't the same everywhere. The recovery was uneven.
Massively uneven. And this is critical for understanding the lead up to the Civil War. The same initial panic had very different long-term consequences depending on the region.
Where did it hit hardest and stay down longest?
The West. Land values crashed and stayed low, maybe 60 cents an acre for public land by 1860, a shadow of the peak. Western railroad stocks stayed deep in the ditch right through the end of 1859. No real recovery. Passenger traffic basically stopped. People weren't moving west.
Which connects right back to that Dred Scott effect, right? The stalled migration.
Exactly. Fewer Northerners moving west meant the market for land and the business for those Western railroads just didn't come back quickly. Population growth in states like Illinois slowed dramatically after '56. The economic pain lingered there, tied directly to that uncertainty Dred Scott created about the region's future.
What about the North, the East? Industrial centers.
A very different picture. Resilience. Eastern and Atlantic railroads, even some in Ohio, recovered financially quite fast. Stock prices were back, sometimes even above early '57 levels by late '59. The big established lines like the B&O, New York Central, Michigan Central, they bounced back. Industry took a hit, unemployment was bad, but the core system recovered much faster than the West.
So the more established, diversified northern economy weathered the storm better financially.
It seems so in the medium run. And now look at the South's railroads, another story entirely.
How did they fare?
Their stock prices barely dipped during the panic itself, and then actually climbed quite a bit through 1859. Financially, their railroad sector looked perhaps the most resilient.
Wow. So the South felt relatively less financial pain, at least in that sector, compared to the West especially.
Relatively, yes. And the panic actually caused investment patterns to shift. New railroad building slowed way down in the struggling Midwest and shifted relatively toward the South in the few years right before the war. Even population growth, looking at Texas versus Illinois, while slowed everywhere, held up better relatively in the South during the recovery period.
Did the different banking systems contribute to this regional resilience or lack thereof?
Absolutely. Another key factor. The North mostly had unit banking. Lots of small, independent local banks. To cope with crises, they'd started developing formal ways to cooperate. City clearinghouses, like the one set up in New York in 1853. These allowed banks to settle accounts efficiently and, crucially, coordinate during panic sharing risk, agreeing on policies like suspension or resumption. There were also some early banknote insurance schemes, like the Suffolk system in New England. Formal structures were emerging because independent banks needed them to survive crises.
So the North built formal cooperation tools for its fragmented banking system. What about the South?
The South lacked those formal clearinghouses or insurance plans, but they had something else, branch banking.
Like one main bank having offices in multiple places.
Exactly. This was common in states like Virginia and Georgia, unlike the North. And the data suggests these branch banks handled the panic better than the South's independent unit banks.
Why? How did branches help?
The structure itself allowed for internal support. A main office could shift funds to a struggling branch much more easily and quickly. Reserves could be pooled or moved within the same institution across different towns. They could also make informal agreements between different branch networks for mutual support. It provided a kind of built-in, albeit informal, coordination mechanism that the North's unit banks had to create through formal clearinghouses.
Interesting. So different paths to coordination, formal in the North, informal via structure in the South, both providing some resilience compared to the more isolated West. But the underlying economic shocks still hit regions differently based on things like migration and speculation.
Precisely. The panic interacted with those fundamental regional economic realities.
And this wasn't just a U.S. story. It spilled over internationally.
Definitely. Remember all that European money in U.S. railroads? When those stocks crashed, British, Scottish, French banks and investors took huge losses.
So the American crisis became Europe's problem too.
To an extent, yes. The financial trouble spread. Sources mention the panic reaching a head in Europe later in '57, particularly in Hamburg, Germany, in December. The market there got so bad, the Austrian central bank had to step in with a big loan to stabilize things. It shows just how linked global finance was even then.
Okay, so the immediate financial storm, the bank runs and suspensions, that part was relatively short-lived. Things stabilized financially by 1858.
Yes, the acute banking crisis eased fairly quickly. By spring '58, specie payments resumed in major centers, helped by coordination and maybe just panic exhaustion. Discussion started about banking reforms. Inflation dropped temporarily. Gold kept coming from California. Financially, the system found its feet again.
And this seems to be the crucial point, the uneven regional impact had these lasting political effects. This is where 1857 really connects to the Civil War.
This is where it gets incredibly significant, moving beyond just economics. The sources argue, quite persuasively, that the Panic of 1857, happening right after Dred Scott, did something critical politically. It emboldened the South.
Emboldened. How does a financial crash, mostly hitting the North and West, make the South feel stronger?
Because Southerners looked at the bank failures, the unemployment, the visible distress in the North, and saw it as proof positive that the North's economy was inherently weak and unstable.
They saw it as based on
What?
speculation, fictitious wealth.
Exactly. Wealth from factories, finance, stocks, things they viewed as fragile, unreal, prone to collapse. They contrasted that sharply with what they saw as the South's strength. An economy built on real assets, land, and, critically, enslaved people. An economy they believed was stable, permanent, superior.
So the North's crisis confirmed their own worldview, that their slave-based agricultural system was fundamentally sounder.
Yes. It was validation. It proved, in their eyes, the North's weakness and the righteousness of their own system. And this fed directly into existing political fights, like the one over tariffs.
Right, Northern industry wanted high tariffs, Southern agriculture hated them.
And the panic gave the South more ammunition. They could point to the North's struggles and say, see, their system is flawed. Why should we adopt policies like high tariffs that help their unstable industries and hurt us? It deepened the economic arguments and the distrust between the sections.
So the panic became another wedge issue, driving North and South further apart, adding economic grievance to the fire of slavery and states' rights.
Absolutely. It provided Southerners with what they saw as concrete evidence of Northern instability, and on the flip side, for the relatively new Republican Party in the North.
Which had formed mainly to oppose slavery's expansion.
Right. The panic gave them a broader appeal. They could now talk not just about slavery, but about economics. They could argue the panic showed the failure of policies influenced by the South and the need for policies that protected Northern industry, promoted free labor in the West, and ensured stable growth, countering what they framed as Southern-linked speculation and instability.
So it helped them win over voters hit by the downturn, workers, businesses.
It expanded their base significantly. This broader economic message helped them win key states, like Pennsylvania, in the elections leading up to 1860. It built momentum.
Which ultimately contributed to Lincoln's election in 1860, the final trigger for secession.
Precisely. So you see, the Panic of 1857 wasn't just some random financial event that happened before the war. Its uneven impact, its interpretation by North and South, had profound psychological and political consequences.
It boosted Southern confidence in their system, their belief they could maybe go it alone, while simultaneously broadening the appeal of the Northern party most opposed to them.
It hardened positions on both sides. It deepened the conviction, especially in the South, that their way of life was superior and the North's was fundamentally flawed and weak. That confidence contributed to the brinksmanship, the lack of compromise, the standoff at Fort Sumter, and ultimately the war itself. One source calls it a real American black swan, an unexpected economic shock that landed right in a volatile political context and dramatically accelerated the path to conflict.
Wow. A crisis born of speculation and bad information ends up pouring fuel on the fire that becomes the Civil War.
It's a powerful example of how interconnected these things are.
Okay, so let's try to pull the main threads together. The Panic of 1857 wasn't just a simple crash. It grew out of this massive, speculative boom railroads, Western land built on shaky foundations.
Shaky because of rampant speculation, but also this incredible lack of transparency. No real financial reporting, little oversight, investing blind, really.
Then came the triggers. The Dred Scott decision wasn't just political. It hit Western land values and migration hard, creating a specific regional weakness.
Then the Ohio Life failure shattered trust across the system, and the SS Central America sinking took vital gold out of circulation right when it was needed most.
Yeah.
All hitting an environment where asymmetric information meant panic spread like wildfire.
And crucially, the recovery, the lasting impact was completely uneven. The West stayed depressed for years, partly due to that Dred Scott effect on migration.
While the North and South, though hit initially, showed more financial resilience in the medium term, partly due to their different economic structures and banking systems, formal coordination developing in the North, informal coordination via branch banking in the South.
But that unevenness wasn't just an economic footnote. It became political dynamite.
It fed directly into the sectional crisis. It convinced the South their system was stronger, the North's weaker. It fueled debates over tariffs and economic policy. It helped the Republicans broaden their platform beyond just anti-slavery. It ultimately contributed directly to the hardening of positions and the slide into civil war.
The big lesson here feels pretty clear. Economic crises don't happen in a bubble. They're tangled up with politics, society, even Supreme Court rulings in ways that can be really profound and unexpected.
And the fallout isn't always distributed evenly. It can hit different regions, different groups, much harder, and those differences can reshape history.
It really underscores how economic stability is tied to more than just markets. It's tied to trust, to institutions, to the whole political and social climate. And weaknesses in one area can just explode when stressed by tensions in another.
Makes you think, doesn't it? About today. How might seemingly specific economic shocks hitting maybe one sector or region interact with our own underlying vulnerabilities or political tensions? How could that reshape things in ways we don't see coming?
Definitely something to mull over. That interconnectedness of money, law, and society is powerful stuff.